Good news for inflation, a resilient labor market, mixed signals from housing starts and permits, and consumers are generally still confident in the short term. Welcome back to us trying to figure out what this past week means for the US economy. Talking about July 14th to July 18th. How much are consumers paying? Well, on Tuesday, we had the Consumer Price Index, which rose by 0.3%, bringing it to 2.7 year over year, and as economists expected. Now, 0.3 might not seem like a lot, but it is significant for a number of reasons. For one, the Federal Reserve tries to keep it at 2% across the board. There are also a number of anticipated tariffs to hit that we're not really seeing the full impact of yet. Saturday, President Trump announced possible 40% tariffs on Mexico and the EU if they do not come to a comprehensive agreement by August 1st. Mexico and the EU are just two of the many other trading partners that tariffs will apply to. Reed Smith put out a great article about this for you to find out more. In this consumer price index, it was the sticky shelter cost that contributed the most to the increase. Shelter could mean rent, hotels, Airbnb, insurance, and owner's equivalent rent of residence. Or if you don't know, basically what it would cost for the homeowner to rent the house that they're currently living in. Now, this could be influenced by a number of things, but my guess is that there's still a pretty solid imbalance between the demand and the supply in the housing market. There's still a lot of people who want to buy houses, and inventory is picking up, but it will take many years for us to actually catch up to it, and that's without any increased demand. This could also be influenced by insurance companies and natural disasters, whereas the insurance companies must raise their premiums to cover for this greater risk of natural disaster as global warming continues affecting this planet. So the answer to how much are consumers paying is more, but it is not escalating as quickly as it once was. So that's the consumer price index. Then on Wednesday, we got the producer price index on the opposite side. We're talking about the average change in what US domestic producers can charge for their products, services, commodities. The PPI stayed largely steady. There were a few ups and downs. Goods rose, services dropped, so a net stall. And this is pretty good news, because if businesses are not charging you more for their products, then they themselves are not being charged more for their supplies, components, etc. If you're a business owner, then you know how steady, reliable prices can encourage growth. Year over year, it's still at 2.3%. So again, higher than that 2% that the Fed always want. But probably won't be as much of an influence in their meeting later this month, because they prefer CPI, which is more of a direct connection to what people are actually paying. However, keeping track of PPI may be an early indicator into CPI, because if people are charging more, producers are charging more, then consumers are naturally going to have to pay more or just not pay at all. So the answer is that producers aren't really charging any different than what they were before. And this is, again, good news for a soft landing. How's the labor market holding up amid all this? Pretty good, actually. On Thursday, we got weekly initial jobless claims, and despite what economists thought, it actually dropped by 7,000. So fewer people are filing for unemployment. This is certainly good news, an indication of a resilient labor market. Good news for the US dollar, too, which could really use it right now after dropping since really the beginning of this year. This also deters the FOMC from dropping interest rates, which if they did, would weaken the US dollar further. So people are staying employed, they're receiving their wages, their salaries. Where is this money going? Are they hoarding it? Are they spending it? So on Thursday, we saw US retail sales. And again, surprising good news. This actually increased by 0.6% when most economists thought it would only increase by 0.2%. And this is after 2 months of consistent declines. We've said it before and we'll say it again, consumer spending makes up 70% of the GDP. So seeing people go out and spend money will certainly have a good impact on that after a contraction in the first quarter. Most people are expecting this to continue to grow as we head into the back-to-school season and people try to buy before tariffs hit. But if that does hit the mark, it will be revealing, so stay tuned. Now let's turn to the real estate industry, as we got housing starts and building permits data on Friday. So we ask ourselves, are developers starting houses, progressing on the projects, and then closing them out to bring the house to market to combat this persistent demand? Building permits in general rose by 0.2%. An increase is a good sign, but it is still almost 4.5% down from this time last year. If we zoom in a little closer, single families specifically slipped by 3.7%, as we're seeing a lot of stubbornness between buyers and sellers to compromise on a price. Multifamilies, however, which are 5 units or more in this case, did rise, again repeating what we said about the CPI and the sticky rent costs. So you get the permit and then you start work. Well, 4.6 of people are starting their projects more after they get their permits. Still not quite hitting the same numbers as last year. And again, we did see single families drop in this category. So you get your permit, you start the work, you progress on the work, you finish, and then you get it to market. Except developers aren't quite finishing and getting it to market. There was a 14.7% decrease month over month and about a 24% decrease year over year. So to answer our original question of are they getting permits, starting, progressing, and closing them out? Yes and no. Developers are marginally starting and progressing on projects, but it's not going to make a difference to combat the demand if they never actually come to market. So that was hard data, but how are people feeling about all this? What is the consumer sentiment in this economy? We got some preliminary information from the University of Michigan, which indicated that consumers are growing confident and higher than what economists expected. This is the highest it's been in 5 months, as a matter of fact. Despite Trump's most recent tariff announcement, it looks like people's concerns for tariffs aren't going as quickly as they were at the beginning of the year. The original tariff truce and pause provided some relief for consumers, but it is still unpredictability that will hold a lot of people back, especially if we cannot come to an agreement with these trading partners and they are implemented on August 1st. Tariffs are the short term, right? That's kind of the near future. But when surveyors ask consumers about the long term, 5 years plus, they gave a different answer. This confidence actually declined by 3.6%. That is lower than the beginning of the year, but still higher than what it was in late 2024. So to answer our original question regarding how consumers are feeling about it, it sounds like in the near term, people aren't really worried about inflation yet, at least. Again, have yet to see how these truly impact the economy. And more so, they are concerned about what these tariffs will imply for the long-term future. And that was July 14th, July 18th. Thank you all so much for watching. I hope you learned something here. Like, subscribe, comment if you have any questions. We'll see you next week.